Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStock, CSW, nor its affiliates, nor any of the respective offices. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media are identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, let's get started. How's it going, everybody? I did you in red already. Let me let's see how I'm doing. Oh yeah, look at that. How nice. I'm still in big trouble here, but I've had a good day. I picked up $3,000. I had 14 short to start the day from when we hit 15.15 yesterday. When it went here, I sold. I should have sold again here, but I was getting ready for the webinar because that would have been another opportunity to make another few $1,000s. But that's okay. As long as I can inch my basis up. So in other words, okay, I'm down $4,500 after making $3,100 back, but now my basis is 1502, and that's 1502 is way the hell down here though. It's not very exciting, but that's all I'm trying to do. I just want to keep working my basis up, because every time I work my basis up, even a point, that's getting me up to where we are now. And my real goal is to have 10 short contracts when the shit hits the fan and this thing collapses. Now, maybe that's never going to happen, but I'm babysitting it on the way up. So instead of taking just one huge loss, it's a very important concept, okay? Because it's important to remember to scale in and scale out. So, when we short here, and then it pumps up to here, we double down when, this is a 10 line. This is 1470. So it goes from 1460 to 1470. But if we double down at 1470, then our average is 1465. Then it goes back to 1465. The big mistake people make is they get greedy. And when it comes back and you're even, you get right the freak back to your base amount. Because if you don't do that and it reverses on you, now you're losing twice as much on the way up. So then what do? So now you have a basis of 1465. So the next time you want to double down is 1475. So you get to 1475, but it blasts right through that. So now you're going to look and see what happens at 1485. At 1485, this is what happened. So we added some more 1485. That brought the average up to 1475, but not good enough. Not good enough. So but then drifting along here. Now, as it drifted along, we got a little braver and added some more. So we took advantage of this dip. This came down to 1470, to 1480 again. It wasn't enough, but it was enough to bring the basis up. So in other words, like adding, if we were at 1475, and then we doubled down at 1485 up here, now our average is 1480. Oh, so I think it's kind of even. Then it comes back to 1480. Then we reduce again. But even if you're not reducing again, if you bounce off resistance, you still take it, because even if it helps you move up, move your average up 2.5, it's good. But in this case, it didn't move us up 5. And then we got burned again. I mean, you're constantly getting burned playing the Russell short. It's a foolhardy thing to do. Then we get burned again. And then we add, then we add some more, and then it comes back a little bit, not enough. Then it went up here. Then we had to add more because we got burned again. Came out of some over here. And then yesterday was another disaster. But fortunately, you see what happens. It goes up, but then it retraces half. So if you scale in and scale out, you're not in trouble there. And then here, big move up, but it took all this time, but it finally scaled back the half that we needed to get back out. And here and here. So as you see on the hole, though, I'm still $5,000 in the hole, but I don't mind that. I was $10,000 in the hole or $12,000 in the hole last week. So slowly but surely working my way out of it. But the more important thing is my basis is now up to 1502. That's almost good. I mean, we're at 1511. It's not great, but at least it's 1502 and not some ridiculous thing. And that's what you do. And now, see, and what happened is, and like I said, here I missed my opportunity. I should have added more and brought my basis up again. At 1515, if I had added more, 1502 and 1515 would be 1508, and I would have been so close to even. Now, if I get to 1508, but then I stop out at 1510, then I'm going to lose 2 points. I'll be back to 1506, but 1506 would still have been great. So, the trick is to just take advantage of, when something spikes up, you got to have a little bit of a feel for when, for when it's done spiking up. Like, don't just automatically double down every time you're in trouble, but watch what's happening. When it starts running out of gas, then you can take a chance, but you still got to stop out. What I do is generally I'll I'll tightly stop out of the extras that I have. So in other words, I'll go short at 1515, and I might have a little bump like this I wouldn't mind at 1516. But if it goes much over, I'm going to definitely stop out of my extra ones. And I'm still going to have the pain of my originals, but at least I'm not doing double damage to myself on the way up. And then I'll try it again later. But that's what it's all about. I mean, if you're going to play it that way, and it's very, very expensive. I mean, you could easily, you guys saw last week or the week before, I was down like $20-something thousand on oil or something like that. I mean, it came back, but you got to be able to go down $20,000. Otherwise, you shouldn't even consider playing that way. This is a rich man's sport, scaling in and out. Otherwise, as we talked about a couple of weeks ago, the way to learn the futures, when you're starting out, or if you have a smaller bankroll, is tight stops. You've got to have a very tight stop discipline. Because frankly, let's go back here again. With a tight stop discipline, you would have made a lot more money than I did, because I don't think I came in this low. But even if you come in at 1460 and you short it and it doesn't work, you stop out, you lose a buck. Then you short again at 1470, and now it comes down to 1465. So now you made 5. Then you try again at 1460, lose another buck. So now you net 3. You go up here, you lose a buck. Not a buck, but you know what I mean, lose a point. So then you lose a point over here, and now it didn't work. So you're now down to net 2. So your profit is still net 2, even though the thing's blasting higher. Comes up here, you shorted at 1480, and look what happens. Now you made it $5. Now you made your 5. So now you're up net 7. Then you wait. It doesn't come back. It doesn't come back. It doesn't come back. So none of these places, that's again discipline. You wait until you're at a good line to short. Then you get up to this line. Fail, succeed, fail, succeed, fail. Well, fail, yeah. So, basically you're still ahead. And then you're basically nothing. Maybe you try again once or twice, but not big ones. But then here finally, 95. 95. You go, oop, try it again. Now you get $5. Then you go back to 95. Try it again, $5 again. Now you try it down here. No, you wouldn't try it here. It's 92. Then you try it again here when it comes up to 15, and it doesn't work. -1, but here's a +5, then -1, then -1. So you're out. Wait. At this line, you try it again, -1. Then at this line, you try it again, and you're +5 again. You see what's funny about that? You're practically 50-50 on the entries, maybe not even 50-50. You might be only 40% successful on your entries. But your winners make 5 and your losers lose 1. And the only difference is that you have a stopping discipline to get out when it's going against you. So if you make 5 times as much when you win as when you lose, you only have to be right 20% of the time. So just be better than do better than batting 200 in baseball, and you'll be okay. Which is what the Mendoza line. I think they used to call that the Mendoza line. It was like the lowest average you could have and still be in the major league. There was a guy named Minnie Mendoza. He was a really good fielder, but he was a terrible hitter. And it wasn't 200, but his average was like 230 or 240. And they used to say that like he was the worst hitter in the league who wasn't a pitcher, but he was such a good shortstop that they that they would play him anyway. And but they said that's like the lowest acceptable average, no matter how good of a fielder you are, that they could keep you in the game. The same kind of thing. You've got to at least be right 20% of the time, or don't play. If you're that bad at picking lines. And by the way, I'm not saying that we mindlessly do this. We don't make all these calls. We stayed away from the Russell for a while. But when it gets to a certain topping point, especially those 10 lines, we like to give them a poke short. Not the 5 lines, but the 10 lines. We generally give them a poke short. Although this morning I called the 15 line short. Why? Because it's freaking ridiculously toppy. So yesterday, actually, when it spiked up like this yesterday, I said, I'm sorry, I've got to short more. Even though I'm losing my ass, I had to short more. And then here again, we had 15, and there's another opportunity to short again. But none of that does you any good if you're playing conviction trading like I'm playing. It doesn't do you any good if you can't afford to make the moves you have to make. Otherwise, you're sitting there staring at the thing while you're losing money. That's unacceptable. You have to play with a very good stopping discipline, or you have to play with a huge bankroll. There's only 2 possible ways to play it. And I mean huge, like if you lose $20,000 or $30,000, you go, oh well, it's not good. But I'm just saying. And I always tell my guys, I'm like, look, like last year, I think I was down $20,000 on trade. It was coming to the summer, and I said, well, I guess we're not going to Europe. But that's you got to play in proportion to your lifestyle. Don't ever get over your head on something. So in other words, I was taking a $20,000 trip to Europe with my family. I hadn't told them yet. And by the way, that's a habit of mine as a gambler. Since I do play these things, I know not to promise my family I'm going to do stuff because I mentally will not. I don't want to go on these trips. I don't want to go on a trip if I'm losing. If I'm having a bad year, I'm not going to start spending money on trips. Or whatever things. I'm not going to tell my daughter she's getting a brand new car when she'd be perfectly happy with a used car. I might want to get her a new car, and so in my mind I put like $40,000 aside to get her a car or something like that. But in reality, though, if I suddenly lose $40,000 playing the market, I'm going to say, you know what, you're getting a $10,000 car. She doesn't know it. She never. That's why I never promise my family. I'm always surprising them. I never like to promise them anything. But if I have a good day, I do something. If I have a good year, a good month, whatever, I'll do something really nice. And if I don't have a good month, we don't do anything. But I would never promise something and then not do it. That's a different story. But you understand? So the point is, if I lose $1,000 in a day, it means I'm not going to be taking my mom out to a Broadway show when she comes to visit me. That's all. Like as it is, my mom's coming up, and I'm gonna take her to go see Hamilton, and it's going to cost me $1,000 to go see Hamilton. That's my plan. Now, if between now and then I lose $1,000 stupidly on something, I'm going to not take her to see Hamilton. She won't know the difference. If I make $1,000, and if I make $2,000, we'll get better seats. But that's how you should be playing with things that are fairly inconsequential. If you're playing with rent money or something like that, don't do it. Just don't. It's never worth it. So, keep it in proportion because, a lot, the problem is half the guys on the site are high net worth people who have millions of dollars that they're playing with, and half the guys on the site, not half, but probably a smaller amount, but, a certain percentage of people on the site, and especially at these things because it's more open to the public, have a regular amount of money, being $500,000, $200,000 in the market. You can't play like this if that's all you have. That's crazy. You have to use the tight stops, and you have to be happy to make 100 here and a couple of hundred here and be thrilled with that kind of return. Because if you learn to be happy making $200 or $300 in a day, there's 200 days in a year. That's still $40,000 if you make $200 200 times. So if $40,000 is something you'd like to have, then learn to play with discipline. Okay, and you have to understand that, like, guys who have millions of dollars, $40,000 is not exciting to them. It's not enough to move the needle, so they want to play for the bigger amount. But that means you have to, unfortunately, take some bigger risks. You know, nothing's free. The basis on the last 10 is 1502. You took a loss on the 4 you bought back. No, I didn't take a loss on the 4 I bought back. I sold the extra 4 at. I'm pretty sure it's right. I sold the extra 4 at 15, and I bought them back at 10. So on those 4, there was a profit of $20,000. So there's a profit of $1,000 on the new 4, which then added a point to my 10. All right, so yeah, I understand what you're saying, but it added a point to my 10 that I had left, and those 10 themselves made a few $1,000s also. Because, I made $2,000. So $1,000 came from the new 4, and the rest came from the other one. No, I know they do some weird system. You have to keep track of your own things. Yes, I agree with that. Thinkers, when you can't go by what they say, you have to know how much money you're making and losing on the trade. Because yeah, they make it, when you start going in and out a lot, it gets very confusing if thinkers swim. And yes, I was simplifying it for the explanation, but conceptually the idea is that I'm selling some. So in other words, in this case, I sold 4 at $15.15. I bought them back at $15.10. So those 4 made 4 times 5 per contract is 20 times the 5-point move is then $1,000. $200. $200,000. It's $5 per tenth. That's why it's $50 per point. I get very confused with Russell because the old numbers were they used to be $10 a contract, and now they're $5 a contract. So it's really annoying. So anyway, but conceptually, that's what you have to do. And yes, you do have to keep track of where your basis really is, because my basis might be lower than 1502. Well, look, my basis is right now, whatever my basis is. If I made 3, I was down 12, and I certainly haven't made any other money on this thing. So I would say I'm still down 9, not 5, or not 4, whatever this is. So I'm still definitely down. So if I have to recalculate 9, and that would be, well, I could tell what that would be. That would be 9 points below here. So, what? Well, 9 points below here is only 1506. That doesn't make any sense. Oh, because it's half. No, it's 18 below here. That's why. So it's really 1497, not 1502. Anyway, so that just makes it more complicated. But the point is, don't go by what Thinkorswim tells you. Go calculate your own basis. That is a good point. Because they screw you up. Because they're saying this is the profit and loss of the 10 that I have left. That doesn't count the 4 that I bought and sold. Really confusing. Whoops. Where'd my thing go? So yes, Rich, that's the correct way to look at it, but it'll take me hours to explain like that. All right. Anyway, what else is going on? Let's see. Let's look at the overall market. So this is kind of some weird action we're getting today. Oh yeah. Hopefully that breaks. It's got to break. I mean, it's so frustrating trying to play this thing short. And again, I cannot emphasize enough. I've been trying to emphasize this over and over again to people. You have to understand, these are hedges. We have plenty along. What we're looking for is hedges. So, there's no study here. Style, load style, 3-day. Oh. All right. Style, load style. Futures. Not working. What style are you? Style, load style. Weird. Style, load style, futures 2. Why is there no study? There's no No, that doesn't make any sense. Is this because the contract expired? Ah, ha, 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 ha. That's why. There's no study because the contract expired. Ah, I figured it out. That was weird. I couldn't figure out why it was not giving me my study. All right, so where were we? So, I mean, oh yeah, I was going to go to the other charts because you can't even look at them on this chart. It's ridiculous. So we back out to the indexes. I mean, what can you say to this? 2420 to 2540. It's 120 points. That's 5%. So, good time for the 5% rule, though. Look at that. We have a 5% fairly uninterrupted move up to the top. So, let's tell you what's going to happen. Oh, that's fun. I love telling people what's going to happen. All right. So, too long term. Here's one. No, wait. Where were we looking? Days. 2420, right? 2420. Well, there's no actual chart here that captures it. So I guess maybe on this one. Let's try this one. I am a stock chart member. My daughter's account. All right. So in the daily view, 2420 is the bottom down here. This is a 5% move. So 5% of 2400 is 120. So basically, if you're bottoming out at 2420, a 5% move up is 2520. I'm sorry, it's 2540, not 2520. It's 2420. So 2540. So right here, where we're peaking out is the 5% line. So, first of all, what's the 2.5% line? That's 2480. Where's the 2.5% line? Right here. See 2480? And you see what happened on the 2.5% line? We hit it, we pulled back, and then we took off. Now, what's the pullback you expect? If you go from 2420 to 2480, that's 60 points. So a pullback is a weak retracement is 20% of the run. That would be 12 points. And a strong pullback is 24 points. So 12 points less than 2480 is 68. 68 is right here. See that line? Your finger is right there. Well, my finger. Well, the finger is that line. Now, below 2468 is 12 more points down is 56. And where's the 56 line? Right in the middle over here. So you can see that does make sense. We had a strong pullback, came back up to the 68 line, and then broke the gap over. See, then we gapped over the 68 line, and now we zoomed along with barely a pause all the rest of the way up to the 2540. Now, there's two ways to look at it, because first of all, don't forget this is daily, so this is decent consolidation, a week of consolidation before the run. So the real run here is a 2.5% run from 2480 to 2540. And that's another 60-point run, and you're going to have the same pullbacks, 12 and 24-point pullbacks. So the most significant pullback, though, because it's the same, the run from the 120-point run is going to have a weak retracement of 24, right? So the 120-point run, very likely to pull back at least to 24, which is only right here. It's not a very big pullback. But also the 2.5% run of 60 points is going to have a strong retracement to 24. So that is the key line here. So if it pulls back to 24 and it holds, it's bullish and it's a strong indicator we're going to go over 2540. If, on the other hand, though, 24 fails, no, I'm sorry, not 24, 40 minus 12 No, my brain is totally fried. 2480. Yes, minus 12. That's correct. That's a weak retracement. 120.9. No, 24. I'm sorry. It's minus 24 is the correct amount. So it's 16. All right. So I'll explain it better. 2420 is your base. You run to 24,540. It's 120 points. Therefore, a 20% of that run pullback is 24 points. Okay? That's a weak retracement. A strong retracement would be 48 points. It would be 40% of that run. We're not even talking about that, though. But on each, and since we did consolidate the 2.5% line, then had a 60-point run from there. So now a strong retracement of the 60 is also obviously 24 points. It's the same 24 points to the same exact spot. That's why it's very significant. So 40 minus 24 is 16. So 25.16 is the key. And we look over here, and there's not much evidence of it being any kind of major support or resistance right now. But that's the point. So I'm sorry. So a pullback to 25.16 is very, very expected. It'd be very weird to go over 25.40 without a pullback to 25.16. Below 25.16, though, there's no support all the way back another 24 points. So you won't get any more support all the way back to 24.80. So those are the key lines we're going to be looking for. Is if 25.16 doesn't hold, we're going to get a nice pullback. So realistically, kind of the same thing goes for the Russell, and that's why that's why I really want to stay in it if I can, because the Russell is probably back up or something. Has a run. Well, the Russell's run is the same deal basically, 1350 though to 1500, and you're going to ignore the spike up and call it 1500. So here we have great consolidation for a year on 1350. So there's no doubt that's a real line. 10% up from there is 1480. 1480. 1350 plus 130 is 1480. Yeah, 1485 basically. So 1485, which is right here. See that little consolidation there? That's the real line. Everything above that is an extra, is a bonus move. But we really expect that to be tested again. It's 1485. That's the real run. But even if we use 1350 to 1500, we're still going to get what? 20% of that is a 30-point retrace, and that's 1470 anyway. So one way or another, we're going to see 1470 to 1485 range. And that's quite a bit down, 25 points. So on the Russell contracts, every two Russell contracts is $10 per point. So you're looking at 25 points is 250 points. And in my case, I'm looking for $250. No, not 200, but 2,000. Sorry, 2,000. It's per tenth of a point. Sorry. Every contract is $50 per full point. It's $5 per tenth. So if you get two contracts, it's $100 per tenth, $1,000 for a single point. So 25 point down on two contracts is $2,500. Okay, that's what I'm looking for. And I got 10. So I'm looking for like $25,000. That's why I'm willing to take these losses. I'll be shocked if we don't come back to like the 75, 85 range. And then if that breaks, I could be looking at a $50,000 gain. So that's what I'm hoping for. It might not happen. If it doesn't happen, I won't get it. But it's the same thing as using tight stops and going for percentages, but on a much bigger scale. Because I'm playing where I'll lose. I could lose 10,000, lose 20,000, whatever. But if I win, I can win 50 to 100 sometimes. So it's just a proportion thing, but it's the same strategy, just in a larger scope. And then, but the nice thing about the way about scaling in and out though is that I can finagle the basis. Like I can keep whittling away at the basis because I have a lot of contracts and I can take some in, put some out, add some, take some away. You can't do that if you're just going in with one contract. Then you just got to play tight stops and try to be smart about your entries and exits. But you've always got to, what is your channel? You've always got to be very aware of what your channel is, where's your channel, your top, bottom, middle of your channel, and only play the top and the bottom of the channel. Now, in this case, like, we thought this was the top of the channel. It went down, it went up, it broke up. But once you lose your channel, you've got to wait for the new channel to show itself. And so it goes up, and as soon as it starts consolidating, they say, okay, around here is going to be a nice short. And that's when you start looking for your next shorting spot. Don't keep picking channels. Let it show you what the channel is. And if it doesn't show you, play something else. I mean, I'm not saying any of these guys are going to be good about it, but like here's the Nasdaq. So obviously, 6,000 is a good shorting spot. That's another one we called it today. I called that here also. Every time I hit 6,000, I'm like, yeah, let's short 6,000. So, and again, here it was perfect, went right down off 6,000. Here we went over, but then made a huge score. Here it comes back up, makes a huge score. Here it comes back up, makes a nice score. Here it comes back up, fail. So that's the first real fail. Well, this one's a fail, but then you succeed right after it. But this is the first real fail so far, and we're already back to 6,000, so it's no longer a fail. Now you're back in short. But here your percentages are excellent. You got a winner, 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 and here the only real loss is here. Or I'm sorry, one stop here. Call that a stop out there, but then you get right back in because it's crossing back below. And here's a stop out, and you're crossing right back below. Oh, that's another good tip for doing this stuff. When you're behind, if you lose $200 and then you make $200, take the $200. You were just wrong. It's a very important concept. You were just wrong, right? So in other words, if you're here and you make you lose $200, and then you suddenly make $200, you say, "Oh, I should take that $200 off the table," and that's it. Be thrilled to be even, and then wait and wait and wait and wait for your next opportunity, and hopefully this time you get a winner without losing $200. But don't squander an opportunity. And I don't mean the second it hits 200, take it off, but tight stops all the way down. And the second it stops going down, say, okay, good, I'm taking that. You see, like this, so some tight stops, you wouldn't stop out here. You wouldn't stop out here. But here, see, this one spikes back up. You would stop out there, but you're stopping out like way down here. And then, you missed. Now, when you have a stop out, though, when it goes back under 59, you can get back in. So you would say, I'm stopping out of this line, let's say. You stop out, it goes up, and then it comes right back down. You get back in, that's all. And then you get the ride down to here. And then it stops going down. You say, I'm going to stop out again. You wait. You go in here. It goes down. You say, good, and you get out. Goes up here. You go short again. Goes down. Get out. Goes up here. Short again. Fail. Stop out. Goes up here. Short again. Fail, but then it comes back to the line, you short again, big win. Then it comes back up, short it again, another win, a loss, a loss, a loss. Not really a win at all. Probably a stop out here is another loss. See, now I have the streak loss. So now, nice win, little stop out, and another attempt, stop out, stop out, stop out. And here, and finally a winner, and then a stop out followed by a big winner. That's the way you play it. But again, not blindly. I'm just showing you all the different opportunities there are, but you still have to look at the news and think of the reports and decide whether it's a good day to short, like into the end of the month. Last week, we didn't short these days because it was coming into the end of the month. We knew it was going to be a bad time to short. Now it's the beginning of the month. We think it's a good time to short. We thought we felt we were going to get pumped up into the end of the month, and we did. Now, what's going to continue? I don't know. So we'll see what happens. So hopefully that was all clear in there. No questions. Let's see. Oh, there are no questions. Look at that. You guys are amazing. I'm amazing. Maybe it's me. All right, moving on then. Oil. Oh, let's get to oil. Oil's right at 50. Another good one, right? It's another one we've been following and shorting. And in the options opportunity portfolio, where is that thing? How's that? Oh, wow. Look at that number. 234. Holy crap. Wait. Am I crazy? I don't think it was that. Shop trades. September portfolio review. Where were we? That's not the OOP. Where's the OOP? Okay, how about I find it? Control F, OOP. Nope. Nope. Okay. OOP. What, shoot? Oh, 321. Okay, I didn't realize we were so high on last week. So a couple of weeks ago, 321, and now 334. That's nice. 13,000 extra dollars. You know, and that's despite Teva killing us. Teva's killing us today. Because we got, what do we got? We got short puts, short calls. Yeah, we are well. We know here we have covered those. Not as bad as the long term. The long term portfolio really hurt it. These are the bad ones. See, these you see, this is a bullshit. 5 open long calls. That was our big mistake here. I'm not getting those back. Those were a big loss. What were we talking about? Something that was good. Oh, SEO, right. So only 10-4. That was like, when was that? That was like 2 days ago, right? Wait, 10-4. That's not right. I made a mistake. I did something with that trade. I was looking at it. I must have accidentally hit the dates. Anyway, the spread we did, whatever day it was, I don't remember what day it actually was. We did the 33.39 bull call spread. I guess it was 9.14 because that's when we did the put. So back on 9.14, the spread was 405 minus 185 is 220, right? 220? Yeah, 220. So 220 on a $6 spread, and SCO since then. Let's see if we have one of those thingies. Okay, stock charts. So we were betting oil to go down, and that was back here on the 14th when it was down here. So it hasn't moved that much really. But again, because we sold the premium on the play, we took advantage of the decay. It's a short-term sale. We played it in the short term, and we're making good money off this top because we expected oil to go down right away. It went against us at first, and now it's coming back up. So our play was 33.39, and we're betting it for November, short-term, not October, but November. We're betting like by before into Thanksgiving, but not over Thanksgiving. We think oil is going to come down a bit more than it is now. But even so far, very nice, right? And we're picking up where these two guys cancel out, 475 and 500. So we're up right about $1,100. So very nice. I mean, it's a nice move on the trade. And we only, we're only in it for 8 minus 67, $1,400. So we're in it for $1,400, and we've already gained 1,000. So that's nice. And that's how we played oil short. As you guys know, obviously, we were shorting it last week also. There's another one we shorted from the futures. Look at that. All right. Oil. Here it is. And that's another one that was just freaking ridiculous. Okay, but 52.50 was an easy short. That was undeniable. We were banging and we were at 52. We were into the shorting too. So it wasn't going so well. Went to 52.50. We went more, and then that's $1,000 a contract. That's $1,000 a contract. Another $1,000 a contract. And today it's $500 a contract. And 50 We're not stupid. It's 50. We took our money off the table. And why did we take our money off the table at 50? We did it yesterday, actually. But why did we take our money off the table at 50? Because 50 is going to bounce. Because, in fact, did we say that yesterday? Where's yesterday's thing? Wednesday. Here, watch this. This is how we tell you what to do. 50.50. Oh, come on. I remember having that conversation. 50. No? Is it Monday? If it was Monday, I'm better than I thought. That's some pretty advanced planning. Okay. So 50-50 gains of $2,500 on Thursday, featured the awesome trade, blah, blah, blah. Okay. Okay, in your comment, so Maya says, in your comment above oil from 50 to 52.50, wheat bounce should be 50-50 and the strong bounce should be 51.50. And strong bounce should be 51. Okay, she's right. Strong bounce is 21. Oh, I can't talk to these guys. All right. Oh, hang on, let me tell them I can't talk to them. Hey, Phil speaking. Okay, hi, I'm doing a conference call right now. What's up? Yeah, no problem. Okay, because I am doing a webinar conference until 3. Anytime after 3, yeah. All right, thanks. All right, sorry about that. That was important. All right, so, all right, so what were we saying? Oh, yeah, all right, so we were talking about the bounce lines, and it was 50-50 would be a weak bounce, and 51 is the strong bounce. So that was from October 2nd, which was Monday, right? Yeah, that was Monday at 4 p.m. That's when we were talking about this. Now, where was oil actually Monday at 4 p.m.? It was here, just coming up to 50. And what happened? Weak bounce, 50-50, fail. Weak bounce, 50-50, fail. All right. And by the way, the only reason oil is holding 50 now, and this is because these guys are desperate to keep oil over 55. So what happened as soon as oil tested 55 in Brent? That's what they care about. As soon as oil tested 55, now oil tested 50. Putin just came across the wires. Putin said he's willing to work with OPEC to extend the production cuts through all of 2018. And that's the only reason oil is not cascading lower right now. All right, but the main point is we can predict. That's all of this is a 5% rule. A fall from 52.50 to 50 is a 250 fall. You're going to get a 20% retrace as a weak bounce, and a 40% retrace to 51 would be a strong bounce. Oil did not make a strong bounce. That indicates it's probably going to go lower. And when you see that happening, when you're skating along the weak bounce line, you can start saying, oh, I'm going to have a little bit, you have a little bit more conviction that it's going to go down. That's when you want to be a little bit more aggressive with your downside play, because you say, well, it's only weak bouncing. And until it hits 51, and even if it hits 51, that's a strong bounce. It's not likely to plow back over there too easily. And in fact, you can see that in action over here. You see how it comes up and finally makes it to 51, but then boom, big rejection to 51, all the way back to 50 before it now consolidates and goes for a move. And that's another thing you get used to watching. If you learn these patterns, you get used to watching that stuff. And I shouldn't say pattern. It's not a pattern. The 5% rule is not a pattern. It's math. It's not PA. It's math. It's a mathematical approximation of how the buy and sell programs interact with each other. And that's what it's all about. It's about when computer algos go on, they start selling, and they sell in a very predictable pattern, and then other algos kick in and start buying in a very predictable pattern. And then the only thing the 5% rule is telling you in reality is which algos are dominant. And so when you see a weak bounce fail, like this is obviously a weak bounce failing, and look, 52.50 to 51.50 is $1, so 40 cents. Would have to come up to here to 90 to be a strong bounce. This is a weak bounce, fails, so lower. Now you get back down here, not even a hint of a bounce off of this thing, so you know you're going lower. Once you're down to 2%, once you have a 2% drop, you're very likely to complete the 2.5% drop. So here we are at 50. Now 50 is significant support. We know that. Very likely to have a buy program kick in. We know that. And OPEC knows that too. So they have their pal Putin get on, suddenly decides to make a press release today at this exact moment saying, hey, you know what? I'm gonna be going with OPEC and we're gonna all cut our production through 2018. Not further cuts, but continue the cuts they have now, which are not working. So this probably won't even give them a strong bounce in the end. But then they'll do something else. So you have to be real careful right now about shorting oil. That's why we switched to the FCO trade. It's easier to ride the ups and downs than to constantly have to worry about where your futures position is. So that's how you use the 5% rule to tell you, like we knew here, what oil was going to do for the next few days. That's nice. It gives you a hell of a trading advantage when you know what it's going to do. All right. Teva question. I originally sold one $30 put or $4.30. Later, I rolled to better than even 222.50 puts for 120. Thus, I have 550. Huh? Oh, I see. You got another. Okay. So you're in 222.50 puts for 275 each. So you're basically in at $20. So, what would I recommend? You know what? I do like them down here. You're right. Good attitude. You're not worried about your short 20s. They'll be fine. I assume they're 2019s. And if they're not, you can always roll to those. All right, so Teva. Okay. So Teva just got the bad news that everybody already knew they were going to have all year long, and the bad news is that their number one drug is getting generic competition. That's all. We knew this. Everybody's acting like it's going to destroy the company. But I just pointed out in chat earlier, I'm like, this is not the first drug company which has had generic competition. That's how the industry works. You have a drug, it has a nice run, it gets generic competition. It's your job to have another drug in the pipeline. There's a life cycle to these things. You run out of your life cycle, and then other people compete like this. There's how many forms of Viagra now? Is Pfizer bankrupt? No. And Tylenol. All these things go off market eventually. And they're still going to have a share. They just won't make as much money on what they're selling. They'll still have a share of the market. They're not going to lose their entire market. They've got doctors who routinely order and prescribe and stuff. They've got patients on it. How often, when you have a prescription from a doctor, how often do you have a prescription and the doctor says, hey, you know what? There's a cheaper generic, so come on in, I'm going to rewrite your prescription for a cheaper generic. It doesn't even happen. It's going to take ages for the thing to drift out. Yes, maybe new prescriptions will come out. Maybe drug companies will put out guidelines saying, please use this one instead of that one. But that's going to take a long time. It's not like tomorrow their whole thing's going to erode away. That's what they're being priced like. It's ridiculous. So, you got to. The problem with analysts is they've never actually worked in the industries they're analyzing. And they don't understand, or anywhere. These guys come out of business school and go become analysts, and all they know is spreadsheets. And they have no idea how a company actually functions. But, the process of selling a drug, first of all, just to get the doctors to start using the drug, you got to knock on their door. You got to invite them to educational seminars, which are actually golf outings. and you've got to take them to lunches and schmooze them and drop off brochures, and you have to show them how the drug works and explain it to them and so on and so forth, especially if you're trying to get them to stop using something they're already using. Doctors don't like patients don't like change, and doctors don't like change, because when they do a change, they're taking the risk that there's a problem. They don't know that Mylan's new drug is as good. They're going to wait until they read some reviews. Mylan got approved today to be able to sell a generic competitor to Teva's drug. And everybody knew this was coming, because actually they didn't think it was coming this quarter. It was supposed to come next quarter. But otherwise completely priced in, other than it being this quarter and not next quarter. So in the grand scheme of things, in a quarter, they'll sell $1 billion worth of this drug, and maybe they'll make $200 million. So honestly, in Teva's the entire difference is 1 quarter of the drug that Teva sells $1 billion a quarter of, which is a lot. I mean, their total sales are what? Their total sales are $21 billion. So they're going to lose they're not going to lose $4 billion of that sale. So it's a lot. 20% of their total sales is one drug, and who knows what the profit impact is. Let's say it's 20% of their profit, so it's $300 million or something like that. So in a quarter, it's a $100 million difference to them in a quarter, which is not insignificant. But in the grand scheme of things, though, it still is only 20% of their profits that are even at risk. So why does the stock drop 13, 14% in a day when all this is already priced in? And it's not that we just discovered now that this drug is going to go off patent. We knew that. It's going off patent 3 months earlier. This is the price for the next 10 years, and we're talking about 3 months. They're really, really stupid. But it is impacting their cash flow. It is a lot of money. Let's say it's $400 million a year. Debt-wise, that would be at least $4 billion worth of debt financing that they don't have the cash flow for. And again, you're assuming they're losing all of it, but let's assume they lose all of it. So they don't have the cash flow for $4 billion debt. So what they've been doing is selling some units to knock their debt level down, so that the rest of the drugs they sell will sustain it. And of course, nobody's assuming they're going to sell anything else, and nobody's assuming they have anything in the pipeline, so on and so forth. They actually have 100-something drugs in the pipeline. They have one of the biggest pipelines of any company. So where were we? Oh yeah, so how to play it, right? So you have the $20 puts. They're at 16. Nothing to really worry about there. You already doubled down this. You don't really want to double down again. That's where you start getting into trouble. Doubling down every time isn't the solution. And sometimes, by the way, when you have a company like Teva and you have a problem, sometimes you want to go with, like, Mylan is the competitor. So you might want to look at Mylan and say, hey, maybe I should, just to offset your risk a little bit, maybe take some of those puts and short and sell the puts against Mylan. They're the ones that are benefiting from Teva's pain. They got a 6% pop. No, I'm sorry. They have a 20% pop today. Wow, that's crazy. So they're up 20% today. But you can still sell the $30 puts for $3, $4, whatever. Whereas Teva, you sold the $20 puts for $5. Well, they are $5 now. So in other words, you don't have to keep all your risk in the same place. So first of all, the 2020s will come out. Now, if you have the January $20 puts, they are $4.30 right now. The January $20 puts. So where would you roll those in 2019? That they roll to the 1750. So they're $4. So for very little money, for 20 cents, 30 cents, you're going to be able to roll to the 1750s down $2.50. In Teva's case, when the 2020s come out, you should be able to roll to the 1750s for about even. So you have that to look forward to. Oh, and by the way, you always want to weigh the concept of, do I want to roll down with the same amount, or do I want to reduce my amount by 20%? You can do that too. So you have to think about what's better for you. You reduce your margin and reduce your outstanding, reduce the number of puts by just rolling out to the same out further in time. So whichever one works better for you, you have to do the math and think about where you're going to be happier. But I think I'd be pretty happy having short 1750s on these guys. Now, what bull call spread? So, what's our goal? Our goal is always to sell as much premium as possible. So, and obviously when we're buying, we want to avoid paying premium. So you want to look and say, okay, if I take the 15s for $4, I'm paying $19. That's $3 of premium, basically. If I take the 1250s for $5, that's $17.50. It's $1.15 premium. So the 1250s, you're cutting your premium in half. Now, if I go to the 10s, they're 17. That's the same 17 as the 15s net me out at. I'm sorry, the 1250s net me out at. Well, I'm sorry, these are really 18s. It's like 1530. They're practically 18. So it's 1780. Still, 1780, not so bad. Your premium is $1.70. That's something you can live with. So that's how I make my decision. I have to look at it and say, well, do I want to spend, if I'm spending $580 here, do I want to spend $750, $1.70 more to be $2.50 lower? And I'm like, no, not really. Not worth it. Let's save the money. So, here's fine because you only have $1.70 in premiums. Now, I definitely want to sell something that's at least $1.70. I want my premium to be covered. So now my next decision process is saying, okay, what's around $1.70 that I feel like selling? Also, what's my target for Teva? Now, my target for Teva is certainly over 20. So I could sell these guys for $2, the $20 calls. That would be a $7.50 spread. So that's interesting. And if I do the $7.50 spread, it's going to cost me $3.30 for a $7.50 spread. There's 100+% upside here. Now, the question is, do I believe they can get to $22.50? Yeah, I do. And am I willing to sell these for $1.40 instead of these for $2? Am I willing to 60 cents to take 60 cents less money in order to potentially have $2.50 more possible upside? So now I say, well, that's a no-brainer, but I have to actually believe that they'll make that $22.50. And in this case, I kind of do. I feel silly not doing it. So that's the spread I would end up going for. So I'd take the 550s for $5.30, and I would sell these guys for $1.40. So you're in for like $3.90 on the 1250, 2250 bull call spread. And then if you offset that with, I forgot what you collected, you collected half of that. So you collected like $2.75 for the short puts. Okay, so for each short put, you collected $2.75 net, and this spread was, I forgot the number, but the spread was whatever the spread is, like 3-something, 380. Let's see, 530 minus 140. Yeah, 390. Okay, so your spread 390 minus 275 is 115, right? So now you're in the spread for $1.15. So what that means is, though, that really your net on this is going to be just $21 to be into Teva as your worst case. And like I said, you're going to be able to roll to the 1750s in 2020. So your net's going to be like $18. So that's your worst case is being in Teva for about $18. Your best case is it pops over $22.50 and you're going to get $10 back to each 115 net you're in. So that's a nice spread. It really is. If we weren't already in it, I would say that's definitely a great spread to get into. All right, so there. We're done with that one. All right, cool. Charts. Yeah, oh, look at that, 1506. See, now I have to agonize. So like 1506, I really probably... I shouldn't, it's hard. It's like I don't want to be greedy because while we've been talking, look, I cut my loss in half. So had I caught 1505, I would have been very happy to go down to 5. I'm kind of pissed I didn't catch it. But, that just cut my loss in half. Profit's just in that 5,000 for the day. And see the bounces? So I'm worried. So if this goes over 6,000, I really got to kind of stop it out. But that's the problem. When you're playing, you really got to watch it because the Russell does this all the time. It makes these crazy spikes down, and then it goes back up, and it goes back down. But it's so great to play if you're good at getting in and out of the thing. And by the way, and again, very important point, I've been doing this for decades. I got a lot of practice. I'm really good at getting in and out and doing all this stuff. You've got to practice, and you've got to say, I am going to get my ass kicked sometimes going in and out, but you've got to practice and practice and practice. Maybe if you can use a paper trading account or something like that to do it, but you've got to get used to just getting into things and out of things and watching how the money works and seeing how your account balance goes. And after doing it 10,000 times, you'll start getting the hang of it. But you've got to put the time in to sitting here and playing it. Otherwise, it's difficult. Like I said, because I was talking to you guys, and I'm like, well, because my attitude at 1510 was either it's going to go lower, and I'm going to be thrilled, or it's going to go higher, and I'm going to add more again. And I know what I'm going to do. But again, I'm playing in a style. First of all, part of the reason I play this style is also because I don't have time. I'm always talking to people during the market hours. I don't have time to sit there and stare at the screen. But had I been staring at the screen, I sure as shit would have taken 1505 and ran. Because it's going to bounce. If you look at this line, it's going to bounce off that line. There's no question. So now the question is strong bounce or weak bounce. There was no bounce here, so we have a 10-point drop. Therefore, you expect a 2-point bounce at least to 1507 or 1506.50, and 1509 would be a strong bounce. So it's not even a strong bounce until it gets over 1509 now. But if it fails at 1507, I'm going to be a happy camper. That means it's probably consolidating for a breakdown. And you know what else is nice? This line, this green line, is 1507.50. So basically, that line, hopefully, is going to now become resistance, and it's going to stay down here. And then tomorrow, all these boxes are going to get redrawn lower because it stayed down here into the close. So the anticipated range for tomorrow will move down. And then other TA people will freak out when they see that happening, and they'll start worrying about their Russell positions, and then we can get a nice sell-off. But for now, I'm expecting it to go to 1507 on the weak bounce. And knowing how to use that 5% rule is going to help you not worry and not freak out about your own positions. It's like, I know what's going to happen. But like I said, logically, if I know what's going to happen at 1505, then I should have taken my money at 1505, and I could have easily gotten back in on the bounce. Or switched horses. So I bet the Nasdaq, here's the Nasdaq, or taking the Nasdaq at 6,000. That's an even better one. You get the Nasdaq back at 6,000, that's a fantastic shorting spot because it's such an easy stop out. A big line like that is going to become a good stopping point. You're going to be able to very clearly see when it fails. So where are we now? Really good. Boom, 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 boom. Okay, good. Oil's still down here. And that's it. And that's why everybody says, how do you know what's going to happen? It's like, well, it's simple. I do the math. It's not that hard. Teva timing question, buying long call now, should we go down higher, recover? Okay. Kind of greedy. It's a nice spread. It's really cheap. I would. It's a little bit of a falling knife kind of thing right now, Teva. Where's the picture? What happened to charts? Now you got to click on a chart. Yahoo. All right. It's a little falling knifey right now, but I imagine. Ooh, that's interesting. Wow, that's kind of cool. Okay, I'm rolling my little mouse tracking thing that's like scanning the chart. Yee. Anyway, see 1550. So it kind of is going to be drawn to that on the way down. All you're doing is stepping in front of a moving train. It's heading down and down right now. So I can't really endorse just naked buying calls now. It seems like a little silly. You should wait until at least somebody starts buying and forming a floor. I don't think everybody's going to suddenly wise up tomorrow. But I think my attitude would be, in the grand scheme of things, since my target is so much higher, I think I would probably buy maybe half now or a third now, just to put a little foot in the door on the position, and then see what happens. But then I would lean towards. So let's say you're doing 15 long, right? I'd buy 5 now as a spread. I would be having my finger on the trigger to buy 5 more as soon as I think there are buyers. I would take the 5 more longs and be naked on the 5 longs and set very, very tight stops for selling the short calls to cover those. Then once I cover those, whenever I do decide to cover those, now I'm 10 long out of 15. Then I'm going to wait and see how it's going. And then if I have another opportunity where I think it's a good idea to buy the naked ones, sure. And if not, I'll just buy the spread, because the spread really, even as this thing firms up, the spread's not going to change much in value. That's another advantage. And by the way, it's important to understand how options are priced and how they work. The in-the-money option will not gain value as quickly as the out-of-the-money option, which will quickly rise in premium as Teva starts to recover. So when you buy deep in the money, and then it won't matter much when Teva goes up. You'll go up, but you won't gain premium as fast as the guy who you're selling to. So the spread is actually not going to change very much. Even if Teva goes back to like 16.50, it's not going to make a big deal in the net cost of the spread. So you have very little to lose and more to gain doing it that way. So in other words, what I'm saying is I would buy out of a 15-part spread, I would buy 5 and 5 right now, 5 long, 5 short. Then I would look to buy 5 long only if I see the bottom consolidation. And then when I buy the 5 long only, I'm going to have a very tight stop, but I'm going to look to sell, hopefully on a bounce, I'm going to look to sell the next 5. Once I complete that, I have 10 and 10. Then I go for that cycle again. And I'm going to look to buy 5 long if I find a good bottom, and then I'm going to sell on the bounce up. All right? And it becomes a lot, but doing it that way, again, I don't do it that way these days because I'm working. I don't have time. And I don't have time, and I don't have patience. I'm a well-off old man, so I don't, can't be, I can't be sitting there fiddling around worrying about, making some extra money, but it's a lot of extra money. I mean, if you can make 10, 15 cents every time you go in and out of these contracts at 100 units a contract, it's $10. And it's $10 here and $10 there and $10 here. And, you're talking about hundreds and thousands of extra dollars just by doing little things like that to improve your entries and exits. I mean, that's how I became a rich old man, okay, by doing all that stuff. It's like it made me money, and I would make more money, and I would put it in the bank, and I put it in my account, and I'd add more money and take more long positions. You have to start somewhere, though, and you have to start when the less you have, the more you should be worried about those nickel and dimes on the entry. Tight stops on longs, so I'm not sure what that means, but you understand what I'm saying. Saying you buy the long, the tight stop is on covering the long. So you think you have momentum. Let's see if I can get that on this chart. All right. Candles better. Candles. Okay, and let's do, let's see if I can do a scrolly wheel. Here we go. Actually, 5 days. Ooh, that's good. Okay. Ooh. There you go. Okay, look. So here you are. This is actually like a day. Ooh, that's a good view. 10 a.m., 2 p.m. Okay, good. This is what I'm talking about. So when you're making your entry, you're watching it go down and down and down and down. Now you see how these candles are getting shorter? Okay? The the volume of selling is decreasing. See these red lines going down, 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 down. The volume of selling is decreasing. This is a big red line, but it's just because it's red isn't the point. The point is it made a pretty short candle. It's in a very tight range. That range is like 2 cents. So it shows a big burst of volume, and the key takeaway here is the big burst of volume didn't make it go higher. Didn't make it go lower. So that indicates the sellers are kind of exhausted. And here you have a big burst of volume again. So apparently what's happening is somebody's still selling, but there's somebody buying for everything they're selling. And then so this is the point where you say, okay, here's my reversal. So at this point, you might want to say, and especially at this point, now you have a candle that went above all the other two candles. Now you say, okay, at this point, I definitely want to buy those long. Then you buy the long. Then you're watching it again. So now you're looking to sell the short. So you bought your long at 16.15. It pops up here. It drifts along. Frankly, right here, I would have probably sold the short. If you picked up 15 cents, that's again, 15 cents is huge. You're doing 10 contracts, 15 cents times 1,000 is $150. So you just made $150 on that. But either way, you have to have a realistic expectation for what it's going to do. And to do that, you look out at the bigger picture and say, well, what do I think it's going to recover to? The best I'm going to do, the best I would imagine doing is getting back to 1660. So once it gets to 1630, I've got to say, well, I'm halfway to my goal. So here it's 1630. Once you're at 1630, say, well, I'm halfway to my goal. That's pretty good, especially if you get it really fast. But even if you held out, you would have held out and watched, what you want to do is make sure it's not going to fall further than here. And certainly you wouldn't want to see it fall below this candle. That would be ridiculous. But as long as it stays above this candle, you could say, okay, well, I'll let that be my range. And you watch and watch and watch, and then you get another move up. And then here, as soon as this candle is violated, you got to get out. But you know what? That's funny because it's right here. It ends up being the same place. So if you had been sensible and taken the money at 1630, you would have stopped out at 1630 and taken the money anyway. But that's what I mean by optimizing your trade. Now, that's if you're being a day trader with your entries. Frankly, when I do it, I'm a week trader. I mean, I'll enter positions over weeks, not days. So I'll take a position in a month. So if I think this is a really good bottom, I'll do the same thing, but I'm going to buy here and I'm going to wait because here's my attitude. If I was going to buy 15 and I buy 5 here, 5 long, my attitude is how much is it really going to hurt me with 5 long if it drops to 15? Am I going to be hurt? No. In fact, if it drops to 15 and I started in at 15.50, I'm going to be happy to buy 5 more long at 50, and my average drops to 15.25. Then I've got 10 long, and I'm going to have a stop below 15 to sell those calls. But if 15 ends up holding, then I'm going to wait for a pop, and I'm going to sell some calls. That's how I make my entries. I'll do the same kind of thing, but I'm like it's the same scaling in concept. I'm going to buy 5 of my 15. And then if those go well, I'm going to sell the 5 and then wait and try to establish the next set. If those don't go well, if I buy the 5 and it goes right down, I've only lost a little bit of money on 1/3 of my position that I intended to start with. So I'm very happy to now go to 10. I'll be like, well, thank God I didn't buy all 15 back here. So then I would double down and have a lower basis, and then I'm happy to sell those calls again. And by the way, another adjustment though is sometimes we talked about the 2250 puts. Now, if I bought 5 and it dove to 15 and then it went to 1450, I would then average myself down, and then I would sell the 20 calls because now I have a lower entry. So I would sell the 20 calls instead of the 2250 calls. So I'm going to, even though the calls might have lost a bit of money, I'm going to collect more money, and I'm just going to have a little bit less upside, but I'm going to keep my cost down. Those are the kind of adjustments you want to make on the fly. Okay, is a good thing, right? All right, let's say. Everybody quiet today. What's going on? Sometimes I can't answer all the questions, and now I'm like, oh, nobody has any questions. All right, so how are we doing? See, 1507. There we are, right on the thing. So a little over though. So at this point, I'm a little bit worried about that. And what do we say? 1509 was going to be the bad point. So 1509 is a strong bounce. We don't want to see a strong bounce. We want to see a weak bounce fail. And we're not getting that so far. 1507 strictly was a strong. 1507 is a weak bounce. It's not failing so far, but we were giving him a little slack because of this resistance line. So we'll see what happens with this resistance line. Is a little more important. But I don't like the way it's going. The other indexes are not particularly bouncing, but they're also not falling to match the Russell. So the odds are we're going to be back at 1510. We'll see what happens. But right now, it's not looking promising. But again, I'm playing this for weeks, not for days or not for minutes. So I'm honestly not really that concerned. But I would have taken the money here only out of principle, because if I get out here and I get back in 2 or 4 points higher, I've improved my position again. So if I know it's going to bounce, why would I stay for the bounce? Why play? There's no penalty to going in and out. So if I know something's going to bounce, I should get out. And that's the same concept as what we were talking about in the Yahoo trade. If I know that the best I'm going to probably do is 1660, when it gets to 1630, I should say, you know what, that's halfway there, it's good enough. Especially if I'm only doing 5. And then I'll start another 5. And if that gets to 1660, I'll get another half. But it literally, it's 100 here and 100 there. And if you make, I remember my broker once, they sent me a thing, it had like my trading statistics, and there were thousands of trades in a year, thousands. And it made me, I really sat there and thought about it. I'm like, oh my God. I'm like, if I just made an extra $100 a trade, I would have a couple of $100,000. I mean, that's crazy. You don't realize it when you're doing it. And a couple of thousand trades isn't that much. It's only trading like 6-8 times a day. So if you're sitting at the, if you're actually trading all day long, that's not a lot of trades. And you don't realize how it adds up. And then if you're throwing away even $10 on 1,000 trades, that's $10,000. It's not it's never $10. It's literally $50, $100, and all that extra nickel, the extra dime, every single time you kill yourself. That's a huge discipline that all traders need to work on. You gotta have discipline, entering, exiting. It always seems like nothing. And especially, by the way, the biggest problem is for guys who have a decent amount of money. Okay, so if you're the kind of guy who goes to Starbucks and doesn't think twice about buying a $5 cup of coffee, you probably don't think twice about spending an extra $50 on a trade entry. You're like, well, I'm trying to win. I'm playing for $4,000. What do I care if it's $50 up or down? But again, if you make that decision 1,000 times a year, it's $50,000. You should care very much about $50 up or down. And the funny thing is, if you care, the vast preponderance of times, you will get your price if you're patient. And if you don't get your price, don't make the play. Go for the next play where you do get your price. Because again, there's a huge difference there. If I only play the ones where I get my price, then I'm never overpaying, and I'm always getting a good entry. And the difference between that and sometimes getting a good entry is vast. And again, though, it's the kind of thing that really, it only sinks in with experience. You've just got to trade enough, and you've got to be aware of your trading enough where you analyze these things. And you can't, it's like poker. Like one of the things I pointed out, we were playing poker with the members in Las Vegas, and we were playing a cash game. So a cash game is different than a tournament. In a cash game, you just play with the money you have. There's no tournament fee. You just put down money on the table. So we all started, I think everybody decided to put up $100 to start. So we all put up $100. And there's 10 of us at the table, and we're playing for like an hour or so. And probably 6 or 7 people at the table were down. But the people who were up were not up enough to make up for the people who were down. And, people look around like, well, what's going on here? And you don't realize that the casino, they take what's called a rate. So every time there's a pot, they'll take anywhere from they'll take $2 to $4 per pot. So they'll take at least 2 and up to, and then 10% of the pot, but up to a maximum of like $4. So if the pot's 200, they're still only going to take $4. So you're playing, you're like, it's nothing really. They're only taking they're only taking $2 or $4. What's the big deal? So if they take an average of 3, and the table plays 30 hands in an hour, or in 2 hours, let's say they play 30 hands, that means they're taking $90 off the table. That's 10% of all the money at the table they're taking. And poker goes on for hours and hours. So by the time 10 people play 4 hours, they've taken 20% of the money off the table. But that, of course, is the basis of our whole system of playing the market. It's be the house. They know for a fact. None of the people know that all 10 people sit down and play poker. We all put up $100. Nobody knows if they're going to win or lose at the end of the day. But you know what? The house knows for a fact that they're going to walk away with $200. And they have no risk at all. They're just dealing the cards for $200. That's the way it works. Same thing here. Same thing everywhere. So many things where that philosophy works. But you have to be aware of it, and you have to think of how to use it to your advantage. So, here's Teva. Where's the shorter one? Days. Here's Teva. We were talking about the day chart. Oh, confusing. In one day, 1610, 1630, 1620, 1640, 20-cent moves. Now, you could be on the right side or the wrong side of a 20-cent move. Try to be on the right side of it every time, because 20 cents times 100 contracts is $20 per contract. If you're trading 10 contracts, that's $200. It doesn't seem like much when you're doing it, but if you consistently add that up, it's huge money. It's really the difference between having a good year and a bad year. Just the way you treat your entries and the way you have a discipline of getting in and out of things. It's very, very important, and something that it's something that's not discussed enough in trading, and it should be. All right. So T. Bernard's the only person talking to me. That's terrible. Lots of people. You guys are all so quiet. All right. I don't care. Less work for me. All right. So where are we? Should we talk about what's going on? Now let's look at the portfolios. I don't want to talk about what's going on in the world. The world is crazy. All right. So like we said, we're up 13,000 in the options opportunity portfolio in 2 weeks. It's exactly what it's supposed to be doing. I mean, it's a lot more than we started with. The goal originally, in fact, when we started the options opportunity portfolio Seeking Alpha on August of 2015, it was called the 5% portfolio. The goal of the 5% portfolio was to make 5% a month. Seeking Alpha said people were confused and thought that we were trying to make 5% a year and nobody wanted to try it, and blah, blah, blah. So I was like, oh, whatever you want to do. I was like, they were like, could you rename it? So I renamed it the Options Opportunity Portfolio. I don't know. It baffles me that people can't, because the title of it was confusing to people, whatever. But we're still on the same goal of trying to make 5% a month. The difference is now we have $300,000. We're up $200 and something thousand dollars. And 5% of $300,000 is $15,000. So in a typical month, we're going to make $15,000 instead of $5,000. That's the only difference. The positions are generally the same. the difference between this, well, first of all, this is an integrated portfolio, so the hedges are in the portfolio. Our main portfolio at Phil Stock World, we have a short-term portfolio, which has the hedges, and a long-term portfolio, which has the long positions, two different portfolios. Long-term position is 100% long. Short-term portfolio, not 100% short, because that one is one where we will take a short-term trade for fun, to try something, but it's where all the hedges are for the long-term portfolio. Its job is to protect the long-term portfolio. So in general, in the short-term portfolio, we are looking for something that's going to do well when the market falls. Even if it's a short-term trade, we don't look for a lot of the long trades. We'll take them sometimes, but usually we're looking for something that's shortable. And the long-term portfolio, any long position that's at least a year out goes in the long-term portfolio. So this portfolio, the options opportunity portfolio, our goal here is just to, it doesn't matter what it is. We look for opportunities where we're going to be able to add and pick up an average of 5% a month. Every once in a while when I do a review, it's a lot more work. I don't do it all the time. But when we do the reviews, sometimes I'll go through each position and say, well, this is how much money this position will make if all goes well. And then all it's about after that is we know how much we're going to make. And I think maybe in June I did that, and we decided that the positions that are in the long-term portfolio or were in the long-term portfolio at that time were scheduled to make $150,000 between June and the end of and January of 2019. That was how much these positions are going to make. We know that for a fact. Unless if the market's flat, we make our money because we're being the house and we sell the premium. So if the market's flat, we make the money. If the market's up, we make the money. Only if the market's down do we not make the money. So barring the market being down, and we have hedges for that, but barring the market being down, we're going to make $150,000 in 18 months. And that was at the time with a $220,000 portfolio, I think. So we're right on track. Although it seems impressive that we're at 330 now, it's only what we expected. A little better than expected. It is what we expected because we've added positions since then. So we've put more positions to make more money since then. But that's because the ones that we had were on track and doing well. And that's all it takes, though, to build a portfolio. You just layer your positions on, but patiently. Don't slam a portfolio together. Another big mistake people make. I don't think the biggest mistake traders make. They make a lot of mistakes. But one of the biggest mistakes traders make is they try to assemble a portfolio all at once. And if you go back on the portfolio tab at Phil Stock World and you look at all the old portfolios, or if you're a Seeking Alpha member, just go back and look for all of the reviews of all the options opportunity portfolios. What you'll see is that we add a couple of trades a month. And when a trade goes well, we stop worrying about it and we leave it alone. When a trade goes poorly, we either kill it or we try to fix it. Look at that. This got double entered. All right, well, that's why this is all messed up. Position actions, let's delete that, but not up as much as I thought. Delete position. This whole position is redundant. I don't know how that happened. Delete. You knew there was something wrong with that thing. All right, so we're only up 235%. So where was that? SEO. So yeah, this is a typical example. On 9/14, oil was, well, I don't know where oil was. Where was it? Let's see. On 9/14, you got to take the Wayback Machine. Well, unfortunately, I don't know. But let's say it was probably around here, and we thought it would go lower, and it didn't. It didn't go lower. It went up first, and now it's back down. But the magic of it is, so we're right about the same place we were on 9/14. I don't know exactly. Oh, wait, I can't make a bigger one. How about that? 9/14? Yeah, we're right about where we are now. We were shorting oil on 9/14. I was worried it was going to go up and down, and so we didn't want to play the futures anymore. Not when it was down here. When it got back to 52, we were gung-ho to short again. But I was worried it would spike up. So on 9/14, we decided instead of messing around with the futures, we're going to flip to SCO spread. Now, the reason for that is because with the SCO spread, if it went against us, we would happily adjust it and roll it and add to it and put a little bit of money into it, and it wouldn't have even cost much, especially not compared to a futures trade. But if this position goes well, it's going to pay 20 times 6, $12,000. So I can win $12,000, but I don't have to go through the horrible headache I would get from trading the futures contracts to do the same thing. Now, even though, like I said, the entry point on the 14th of SCO was basically the same place it is now, because what did we do? We bought the 33 calls, which were in the money. So we bought them for $4, and they're $2. They're almost $3 in the money. So we only paid $1 premium. Then we sold the 39 calls. They're totally out of the money, and we collected $2 in premium. So already we collected $2 back on $4, and now we only pay $2 for the spread, and it's a $6 spread. Then we sold some puts. The 35 puts also, we sold all premium. 35 puts are out of the money, and we collected $3, but it's on half, so we collected $150 per long. But now we sold 4, we collected $195 plus $150, it's like $350 out of 4. We only paid 50 cents for the $6 spread. So for each $6 spread, we paid 50 cents, and the spread is $3 in the money. Who doesn't like that? And what are we doing? We're being the house. I sold a guy puts because he thinks it's going to go down. I sold a guy calls because he thinks it's going to go up. But I sold more calls than puts because I covered the calls. I can't lose money if he wins. And on the put side, that's my risk area. And should oil go flying up, SCO, which is an ultra short on oil, will go down, and I'll be stuck with a short position on oil, which I will then have to roll and do something with. But again, based on my long-term overall view of oil, I don't mind being short on oil. And one thing I do know for a fact is eventually his premium is going to go to 0. And that means that if I sold him the $35 puts for $3, he doesn't make any money until SCO is at 32, until SCO drops 10%, which is like 5% in oil. So unless oil is over 52.50, which I really didn't see happening, we're going to make money on this trade. It's almost inevitable. Because even if we drop to 35, I'm still going to collect $2 off these guys. And I only paid 50 cents. So because of these calls, my break even is more like 34. Break even is something like 34 is about the break even on this whole trade. Because even if I lose $1 here, I make $1 on the call. And I have more calls than puts. So actually, my break even is more like 34. Let's call it 34. Probably 33.50. So in other words, we're entering a trade where a lot of things have to go wrong for us to lose, and hardly anything has to go right for us to win. And the reason that is just like Vegas. In poker, it was poker tables. This is why they love these poker rooms. They can't lose. You're paying them. 10 guys are paying them 20% of their money to deal cards. Can't lose. Those guys, the poker room cannot lose. That's the great thing about it. The only way they lose is when they overstaff it. Other than that, they cannot lose money with a poker room. And that's why you see Bally's in Atlantic City, which is owned by Caesars, has a gigantic poker room. I mean, 100-something tables. So it's just, and again, you say, so what do they make at $100 an hour? Yeah, they make $100 an hour times 100 tables. That's $10,000 an hour, and it's pretty much going all day and all night long. So it's a couple of $100,000 a day, and that's like $6 million a year coming in on the brokers. That's nice. That's good money. Or is it $60 million? Is it $200,000 a day times 3 is 600,000, 60, 6 million, 60 million a year on poker. Just taking $2 a hand. So, isn't that a business you want to be in? And that's what we're teaching you guys on these long portfolios. The reason I keep running these portfolios, I wanted to hammer this home because I realized in 2015 or in 2013 when we started doing these long-term and short-term portfolios, I said at that time I felt like I wasn't getting through to people about the benefits of the long-term investing and the whole being the house strategy. So I've spent 3 years, 4 years now just hammering this concept home, and I really hope it's sinking in. But look at the money we make on these portfolios, and all we're doing is this. It's so simple. We take a position where we pay less premium, and we sell much more premium than we're paying. Again, it's not $4 a premium. We own a position that's with SCO at $35.75. We pay $4, so $2.75 is in the money. We pay $4, so $1.25 is out of the money. That's the premium we're paying. But these guys are all premium, and these guys are all premium. So, and had we fully covered on the puts, we would have sold $4.95 in premium versus $1.25 in premium we paid. It's almost impossible to lose when you do that. So that's the be the house concept, to sell frickin' premium to everybody. But the other very important thing, though, in this case is you have to be a decent fundamental picker. Pick a stock that is very unlikely to go down, or if it goes down, that you'll be very happy to own it at that price. And if you really, truly have the budget to own it, and you really would love to own it long-term at that price, then you really can't lose. All right? Because then it's like, if the stock was a Mercedes that's usually $60,000, and you say, okay, I'll buy it for $40,000, and the guy pays you $10,000 to promise to buy the Mercedes for $40,000, or $5,000. So now your net is $35,000. You promised to buy it for $40,000. He gave you $5,000, so your net is $35,000. So either you're going to buy a Mercedes for $35,000, that's usually $60,000, or you're going to just keep the $5,000 and you don't get to buy it because it didn't get cheaper. But there's no bad outcome for you because you know for a fact you want to own the car. If you know for a fact you want to own the stock, it's the same thing. The problem is people don't think that way about stocks. You think you only like a stock if it's good. You only like a stock if it's paying off. You don't like a stock if it's having a hard time. You don't like a stock if it's down on you. Teva, for example. Right? Let me just talk about it. Teva, for example. I don't care if other people don't like the stock and if the price of the stock goes down. I like the stock. And so if it gets cheap, I want to own it in my portfolio, and I don't care if it doesn't go up this year or next year or whatever. I do care if it never goes up, but on the whole, I'm just freaking thrilled to own it at that price. And it's just like when you buy a house, right? You buy a house for $400,000, and you expect it'll go up to $500,000, maybe $600,000 while you own it. That's what you expect. If it goes down to $350,000 though, 6 months after you buy it, 2 years after you buy it, you don't dump the house. Because you intend to make use of it for that long. Now, how do we make use of a stock? As our plays mature, we will sell some calls against it. We'll sell more premium. So in other words, the stock that we own long-term becomes then a vehicle for selling calls against it. And again, this is where Teva is interesting, because Teva, even at $16, let's go to Teva now. Even if we ended up owning it and it's $16, and let's say we own it for $20, and it's $16, oh look, we're on Teva. Even if it goes to $20 and we bought it for we bought it for $20 and it's $16 now. What can I do with my shares of Teva? I could sell the what the hell is this? Oh, because it's so low. It's like all these are zero. It's at 16. I could sell the January 1750 calls for $1. It's only 100 days from now, so 3 months. I can sell so 10% out of the money, and then so in other words, for this guy to get his money back, Teva has to go up 10% to 176 to 1760, and then it has to go up another $1 just for this guy to get his money back. So that's 10% plus whatever, like 20, maybe 15% or 14%. So Teva has to go up 14% just for this guy to get his money back. And if he does get it back, all that happens to me is if it goes way up, then I have to sell him the stock for $17.50. Plus, I get to keep the dollar, so I'm selling for $18.50. So even if I own Teva right now for $20, and it's at 16, I'm down $4. I can already reduce $1 of that, 5% of my money back in 3 months, just by selling these calls. If it goes up and I get called away, I'm going to get called away at $18.50 with a $1.50 loss, but that's a lot better than a $4 loss I have right now. But if I don't get called away, I've collected 5% in 3 months, and I've lowered my basis from 20 to 19. Then I do it again for 3 more months. I do it again for 3 more months. I do it again for three more months. By the time I do it for the 4th time, 1 year from now, after I sell 4 sets of calls, I've reduced my basis from 20 to 16. So now if I get called away at $17.50, I have a profit. But I mean, even then, I don't want to get called away at $17.50 because I get 20% back on this stock. I'm getting $4 a year selling calls against a $16 stock. What? It's better than dividend. And they pay a 6% dividend while you wait. So when I say I don't mind owning Teva long term, that's why I don't mind owning Teva long term. It's a fantastic stock to sell calls against. And by the way, this is a very low VIX environment. If you had a better VIX, if the volatility was higher, these options would be 30, 40, 50% higher than they are now. And you'd be collecting 30% a year against your $16 stock. That means in 3 years, you collect all your money back. So I want to own it for 20 years and collect 10 times my money back. It'll pay you over and over and over again. That's what I mean by owning things long term. And we have stocks like that in the long-term portfolio. And I started putting stocks like that in the options opportunity portfolio because I want people to understand how that works as well. We have Frontier, another dog, right? Frontier's in the doghouse. We bought it for 25. It's 12. We didn't buy it for 25. We bought it for some higher number. We doubled down, and currently our basis is 25. Stock's at 12. So what did we do? We sold some calls, not all, partly covered the calls. We sold the calls for $3. That knocks our basis down from 25 to 22. Then we sold these. We sold these calls for $3, right? And we sold some puts for $6, $7. That knocks our basis from 22 down to 15. Stock's at 12. Holy crap! So in 18 months, we knocked $10 off our basis. I don't want to get called away on Frontier. I want to sell frickin' $10 worth of premium every year against my $15 stock. That's frickin' incredible. And they're paying me a 10% dividend while I wait. No, not even 10%. I think it's 20% while I wait. No, that doesn't make any sense. Really? What are they paying? Where's Yahoo? FTR. They cut that, right? They're not paying that. No, they are. They're paying 20%. Oh, my God. They are paying a 20% dividend on top of all the options you can sell. It's raining money when you have positions like this. And the problem is that all people look at is, oh, my God, I bought it for 25 and now it's 12. And I'm thinking, I don't give a crap what the price is. I only care what I can make out of what I have. Okay, because if I did pay, we paid $25. Forget that. We paid $20,000 for the stock, but we're going to get paid $1,600 in dividends. More than $1,600, whatever it works out to, but $1,800 in dividends. So we're going to pay $1,800 in dividends. And we're going to get paid $4,000. We already got paid. We collected $4,000 for those and $1,700 for those. So what I say, 18, so that's 25 plus that is 65. So $6,500 for not even 18 months of a stock. So that's about 30-something percent return in 18 months. 10%. Every 6 months, 5% a quarter return, owning this stock, and that's against our $25 entry. Once we whittle that down, once either the stock comes back in price or we whittle down the basis, then the returns become ridiculous. Then you're getting 10% quarterly returns on the stock. And frankly, if you come in from scratch now, that's what you're getting, 10% quarterly returns. And we're not even fully covered. That's without even having a full cover on the stock. So, the reason we make this crazy money in the portfolios is because we're following a system that works so well. It's the same system that lets Steve Wynn be a billionaire. Okay, you just keep taking the nickels and dimes. The same nickels and dimes that you guys tend to throw out when you're making trades, we're collecting them. You don't think it's good to make it. You don't want to spend the time to make a better entry. I do. We'll take the money. And you want to bet Teva goes up, I'll take the bet. You want to bet Teva goes down, I'll take the bet. I don't give a crap which way it goes. Because either you're going to call away the stock that I own, or if I have a call, then you'll call away my long call. No big deal. Same thing for me. So you're going to call away the stock I own at a profit, or they'll expire worthless, and I'll still have the stock, and I'll find another sucker and sell to him next year. Or it goes down, and I will sell, and again, I'll still sell to other suckers, or I'll buy more because it got cheaper. There's really hardly any bad outcomes for me as long as I keep my bets in a reasonable proportion of my portfolio. No single position is going to kill us. Hey, I tell you, what could Apple could kill us. If Apple completely crashed, that would be bad. We do have a very heavy position on Apple. We have a very heavy position on Apple because it's like physics to me. I don't believe it's possible for Apple to kill it. So therefore, we have a very large Apple position, but we do have it hedged with a large SQQ hedge. So if Apple goes down, SQQ is going up. That's an absolute fact. And then again, we're back to where we started. So now we're saying, okay, well, Apple killed us, but we collected $60,000 there to offset the loss. So that's our only major risk in the portfolio. Everything else is very, very bite-sized, reasonable amounts to risk. And if your portfolio is a third of this size, is $100,000, then take 1/3 of these sizes. That's all. It's not complicated. Your portfolio is $3 million. Take 10 times. That's all it is. It's not complicated. Look at the retail one. We called the retail one when that was cheap. That was nice. We have wheat and precious metals. That's doing well. I mean, none of these are doing that. Well, the other thing is, like I said, picking good stocks is important too. Now, obviously, we're always going to have red because we're betting against ourselves. We're hedging. Every position is self-hedging. We are selling premium to everybody, so we can't win on both sides. You can't beat the caller and beat the putter. It's not that likely. So we're going to have at least something red on every position. But the only bad position is when you see a bunch of reds stacked up. So we don't, like nothing, all good. Teva we know is bad. SVU is not that good. But if you look at the numbers, 1,700 here, 1,000 there, 120 there, it's still ahead. That's a bad position for us. We're only a little bit ahead. Good. Ridiculous. Good. Good. Okay, here. Finally. Chesapeake. And there's nothing wrong with this one either. The only thing bad about this is the premiums right now are out of whack. So basically, it looks bad because the premiums are high on this position. But what did we do? We sold 20 of the $5 puts for 120. That nets us in for 380. And the stock is now at 425. So these aren't a loss. They're showing the loss, but they're not a loss. As long as it stays up at this level, we're fine. Then what's the other one? This is another one of those cases where it looks bad because the short calls have gained. The short calls have gained on it, so that looks not so good. But this position's fine; it's completely on track. But it shows a loss, so we'll call it a loss. Then everything good. That one's good, and that one, SCXY, always bad, never, because that's betting long VIX, that never works out for us. And the other two are good. So what do you got? 3, 4 losers out of 30, 1, 2, 3, whatever, 35, 36. All right, so 36. So out of 36 positions, we got like 4 plays that aren't making money. That's good. But why is that happening? They're not even all up. But what they all are is they're all collecting premium all the time. It's like owning the poker table. I know for an absolute fact I'm going to win 20% of the money. I'm never going to win 100% of the money. See, actually, I'm sorry, nobody at the poker table, this is the funny thing, nobody at the poker table can win 100% because the house is going to get it. So the longer it takes you to win, the less money there's going to be for you to win. But, and in reality, money comes and goes and people go in and out. But the reality is if you just sit down at a static table with 10 people and you're going to play for 2 hours, basically the most money the best player can win. If he wipes everybody out, he's still only going to get 8 times his money. He's only going to get 80% of the money at the table. The house is definitely going to get 20. So this kind of style that we're playing, we're never going to get the giant win. But we're always going to get the reasonable wins. We're always going to get a 20 to 40% return playing this way. If the market is bullish and things are going well, we're going to make 40%. That's what we've been making. The money, even though it looks like a crazy amount of money, 200, blah, 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 a 200-something% return, 230% return over, 4 years? Is it 4 years? Oh, no, this one's not even 4 years. This one's 2 years. This portfolio is more aggressive. And the long-term portfolio, it's since 2013, which is 4 years. It's 40% a year compounded in the long and short-term portfolio. This one's more aggressive, and we've actually made some really good picks, so it's doing a little better. The thing is that, that's basically all you're going to expect, though. We're never going to get this kind of win. Is not very likely the way we play the long and short-term portfolio. But in these kind of trades, the bottom line is it's so easy to make 20 to 40% consistently every year, year after year after year. And the only time you don't make it is if the market goes, you can break even. If the market goes down 10, 20%, you're still going to break even because of the hedges. If the market goes down 30, 40%, yeah, you're going to lose some money, just like everybody else on the planet. But the good news is you won't lose as much as everyone else, and you'll be able to buy things cheaply at the bottom. And that's what this strategy is all about. But generally, and saying it's exactly what Warren Buffett does. Year after year after year, you are in there and you've got cash and you buy more stuff and you build your portfolio and it gets up. But we didn't do it by slapping 30-something positions down. We added a couple of positions every month. 2, 3, 4 at the most in a month. And the same thing with the long-term portfolio or the short-term portfolio. The butterfly portfolio is the oldest portfolio from summer of 2013. It's up 300%. And the funny thing about the butterfly portfolio is it only has a dozen positions. We almost never change it. Because this portfolio is all about selling premium. That's all we do. Sell premium, sell premium, sell premium. But the reality is all this is like 40% compounded return. But the trick is to make it consistently. That's the key. You have to make it consistently. There's nothing more important than that. And that's what the system is. And by the way, it's boring. It's a boring system. It's just you don't touch your portfolio. You don't mess around. And by the way, it's another reason we have a long-term portfolio and a short-term portfolio. The long-term portfolio is so freaking boring that you have to have something else to do. So at a certain point in my own trading, I realized I should have another portfolio where I make my quick trades that's much smaller than my big portfolio, which is constantly making money. That way I don't get out of control. That way I've got a manageable amount of money. Our short-term portfolio started with $100,000, and it's at so we started with $100,000 in November of 2013, and now it's at $450,000. And look at the cash, $450,000 in cash. This is the aggressive portfolio. We move around, we take risks, we do all kinds of stuff. So sometimes we've been fairly lucky in this portfolio. The long-term portfolio, no, we're not risking crap, other than obviously being long in the positions. Long-term portfolio, we started with $500,000. So in other words, $500,000 in our long positions, $100,000 for our hedges. And in the long-term portfolio, we have a lot of positions. We have 38 plus 6 is 44 plus 15, 49, 59. So 60-something positions in this portfolio. Because it's a long-term portfolio, after 4 years, even though we only put 1 or 2 on a month, they add up. Can't help it. And since we don't pick too many bad positions, there's no reason to take them out. So we just end up with more and more and more positions. And it's the same kind of thing though. Green, 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 green. There's like hardly any losing positions. And there's two types. Obviously, it's an up market, so anything long is obviously going to do pretty good. If you're picking long, they shouldn't do too badly. Look at the short put. Only 2 losers, and they're only down $150 between them. Out of 15 short puts. You're not going to lose much money in a downturn because you've already hedged everything out. And in any kind of market that's flat, you don't care if it's flat because you already sold all the premium. You sold puts and calls. In fact, flat can sometimes be, in the butterfly portfolio, the best market for us is flat because we're just selling puts and calls to everybody. We don't give a crap if it goes up or down. We're always selling premium. In the butterfly portfolio, we're literally playing, it's like playing the house game of poker. We're just taking a rake for owning the stock. We take as small a position as we can to control the stock, and then we sell lots of puts and calls. In the long-term portfolio, we are taking a value position in the stock. We intend to own it long-term, and when we think the market's topping, we sell calls, and when we think the market is low, we'll generally buy the calls back and then play long. So we're timing the market that way, but we're not generally messing around with our positions too much. We hardly ever touch it. And the short-term portfolio is where we'll make an adjustment if we worry about the market being too toppy or bullish or bearish or whatever. That's when we'll make our adjustments. So then, so that's a small portfolio that makes the adjustments, and the long-term portfolio sort of chugs along like the big battleship. And we're like the little cruisers that go by the battleship in the short-term portfolio, just making sure that the way is clear. All right, so that's our strategy in a nutshell. And it's not that hard. It really isn't. And if you guys are struggling with portfolios, it's like you really got to think more about the selling the premium concept. And please ask me about it in chat. Let's talk about positions. Go over the portfolio things. Look for whenever we do a review. Where's the review? Here. So let's say Control F. Good. How many times did I say good for a new trade? 29 times I said good. Doesn't mean that I always say good for a new trade. Here you go. So Berkshire, good for a new trade. ESRX, good for a new trade. Whatever that was good for a new trade. CLNS, good for a new trade. CLS, good for a new trade. Cisco, good for a new trade. DIN, good for a new trade. It's not complicated, right? SCR, good for a new trade. Good company. Oh, that wasn't necessarily good for a new trade. But anyways, at least it does in here. No, that just says good. IBM, good for a new trade. TSO, nope. SVU, good for a new trade. Nope. And CHK, good for a new trade. We just looked at them. Cisco, again, good for a new trade. DBA, nope. GE, good for a new trade. MO, good for a new trade. Boy, is that good for a new trade. What a deal down here. Philip Morris. Super Value, nope, that just says Super Value, but it was good for a new trade before. And XRT was good for a new trade. So, yeah, more than a dozen that were good for a new trade. So at any given time, all you have to do is go to the portfolio reviews and see which ones it says are good for a new trade. And then definitely, if you want to get into a new trade, talk about it. But like I said, we built these portfolios adding a couple of positions a month, not dozens in a month. And you do that because the market goes up, the market goes down. You're averaging into the market without getting ripped one way or the other by the big swings. And because we're selling premium on both sides, we don't care that much whether it's up or down. We just want to get a bargain stock and start selling premium against the bargain stock. And we assume that over time, the valuation, the value proposition of the bargain stock will take care of itself. Just like that Mercedes, that's a $60,000 Mercedes, you sell the $40,000 puts basically for $5,000. So you must buy the Mercedes for $40,000 at least if somebody wants you to buy it. But if the price of the Mercedes goes up, no one wants you to buy it. If the price goes down, they're going to force you to buy it for $35,000 for $40,000, less the $5,000 you keep for the contract is $35,000. And as long as you really want the Mercedes and think $35,000 is a good price, what do you care? Even if it's a $20,000, what do you care? You're like, I got my Mercedes. You could have gotten it cheaper. Okay, I could have gotten it cheaper, but you get to drive it. That was the whole point. You didn't want to pay $60,000. You offered to pay $35,000. You gave yourself a massive discount. And maybe it goes up and maybe it doesn't, just like the FTR we were looking at. I don't care. I get to use it. I'm using FTR to generate 30% annual return. I don't really care what the price of FTR is. It doesn't matter. It's irrelevant to the 30% I'm collecting. That's when I care. I care if I can't get my 30% return, then I start worrying about the position. But as long as that position is paying me 30%, I don't give a crap what people think it's worth. Because I'm going to be in it for decades. My kids are going to be in it for decades. Who knows really? But, in theory, it'll be like AT&T or Verizon or anything else. It's like a stock that's in your portfolio and it pays your family for generations to come. And your estate just doles out the cash when it comes in. That's all there is to this stuff. And like I say, decades. If you're young enough, I'm 55. I'm not 55. What am I? 54. I'll be 55. So I'm going to be 55 though. So I'm not planning for 20, 30 years out so much. I'm just like, well, whatever. But if you're 30 and you're talking about generating these kind of returns for the next 30 years easily, then you're going to retire with a nice boatload of money using this system. And not just money though, money that generates an income constantly and a very, very good income. That's what you want to be in. All this day-to-day messing around stuff, it's really not something you should be doing if you want to plan for retirement. If you want to plan for retirement, go the boring route. Build a portfolio, build your wealth, learn to do the steady, consistent game. That is my statement for this week. Anybody else? No. Okay, fantastic. 3 o'clock, time to end it. That's your lesson. All right, guys, thanks for coming. Have a great week, and we will do it again next week. Take care.